Interest rate has tripled since last year, going from just 2% to now 6%. The question that everybody have been asking, will interest rate continue to rise and when is it going to stop? Is there a possibility for interest rate to hit the double digit, which is 10%? What's going on, everybody? It's Blandon here from mortgagehq. Latest New Zealand inflation figure shows that we're now at 7.2%. But let's be real here, because my petrol bill has gone up significantly. My wife is needing way more than 7.2% on the grocery bill, and the industry as a whole with construction, we have seen a massive slowdown because the construction cost has increased quite a bit. So is there a possibility that interest rate would hit 10%? When there are uncertainties in the market, it's easy to shift our mental capacity to things that we are not in control of. So in this video, I'm going to show you part 1 of the 7 strategies and tips on how you can take back control of your finances in this high interest rate environment. It's going to help you manage your cash flow through this period and come back stronger than ever. Whether you're a first home buyer or an investor, I'm confident you'll be able to find value in this video. And when you do, please smash the like button for the YouTube algorithm. So the first strategy is to do your numbers. Do you know how much it's going to cost to sustain your property portfolio? What if interest rate were to go up to 7.5% in the next couple of weeks? What does everything look like when interest deductibility is completely phased out? It turns out most people that we talk to don't really have a good understanding of what that all looks like. So here's a recent portfolio that we have reviewed, and as you can see, this mortgage is around 2.1 million. I've just put 100% finance here just for this illustration. Now, interest rate is currently at 4%, so this client's doing quite well because their yield is around 6.89 and they are cash flow positive. Now, as soon as interest rate were to go up to 6.5%, because that's where we are right now, they would go from a cash flow positive position to a negative 48,555. This is also considering that interest tax deductibility is phasing out and is going down to 25% next year. So this is something that we all have to be prepared for. And we're going to find that this is going to be a trend for a lot of people if their portfolio has a lot of single dwellings and they're in the main city. Even if they're in the region, the yield is usually relatively low. And so it's important to get on top of the cash flow by doing some projections. It is most likely to be your biggest expense. Now, if you want to have access to this yield calculator, you can just download it from the link below. And if you get stuck, feel free to reach out to one of our advisors, support@mhq.co.nz. Second strategy and tip is to make sure you have enough for a runway. Now, in the example that I've just shown you, potentially this portfolio would go from positive 7,000 to a negative 50,000. So you know you need at least $50,000 in the bank to have a runway of 1 year. Otherwise, you'll be dependent on your personal income. On top of that, you want to have around 6 months of living expense. This should just be accessible as an emergency fund. And of course, if you have all of this accessible in your offset account or revolving credit facility, is going to allow you to have both the flexibility and the most interest savings. So the good thing for our client here is that they have a 150K revolving credit facility available. So that means they could at least sustain for 3 years if they just kept working and just lived off their income. So make sure you have that runway ready to go. If you don't, try and top up for a revolving credit facility. Here is the third tip. Interest rate averaging. You have probably heard me say this 100 times. Essentially splitting your loan into different fixed terms. So not all of your loans are coming off at once. Can't stress the importance of this because for those that didn't use interest rate averaging in the last couple of years because they saw that the 1 year rate was 0.2% lower than the 2 or 3 years and they would save a few $100s, now they'll be feeling the pain because it would cost them tens of thousands of dollars. Now last year, interest rate got to as low as 2.99 for 5 years. I even managed to get below that for one of the bigger portfolios in private banking. And those clients are in the strongest position ever. So what is the moral of the story? Stop guessing where the market is going to go or where interest rates are going to go. We can luck out sometimes when we guess right, but it's definitely not worth spending a few more $100s now and potentially losing tens of thousands later when interest rate were to spike or drop significantly, which is unlikely. But at least you could take advantage of a lower interest rate if you were to take interest rate averaging. And here's a fourth tip. Look for opportunity to freehold some securities. This obviously only applies to property investors. But if you had your portfolio for more than 2 years, I have no doubt that you have built good equity in your property portfolio. And the best thing you can do is to take control of where that money goes if you were to sell those properties. Now, if all of those properties are secure with the bank, then they will be in control. And if you got into a position where you need money in a hurry and you couldn't borrow the same amount, the bank will likely take back a lot of that sales proceed, meaning you're selling cash flow and you don't really get the effect that you want, which is the cash in hand. And in another video, I also go over why you should freehold your investments before you're owner occupied. I'm going to leave a link in the description below. So by having some freehold security, which you can probably do because values have gone up significantly if you held your portfolio for more than 3 years, then if you need to sell something, you can have that cash on hand. So there you have it, folks. Those are the 4 tips and strategies of the 7 you can apply in a rising interest rate environment. In part 2, we are going to get a little bit geekier and look at more sophisticated strategies that you can apply to higher interest rate environment. So be assured to subscribe and hit the notification bell if you want to check out that video. And if you have found value, don't forget to smash the like button for the YouTube algorithm. It would help our channel immensely. So in summary, the first thing is understanding where the cash flow is going and how much is it going to cost you to maintain your property portfolio. Forecast based on interest rate rising and interest deductibility phasing out. Second is make sure you have a bit of runway. Have some money sitting in your revolving credit facility. So if you're in a negative cash flow position, you can ride it out for the next couple of years and make sure you have that 6 months of emergency living expense as well. Thirdly, don't guess where the market is going because interest rate averaging takes that guesswork out and it's going to allow you to have dollar cost averaging over time. It might cost you a few $100s extra right now, but it could save you tens of thousands of dollars. And fourthly, look for opportunity to freehold some securities because if you held your portfolio for more than 3 years, chances are you'll have some extra value. You can freehold those security and in time of an emergency, you can sell those assets and have that cash in hand liquid. Again, you don't have to go alone because if you want some guidance and some support, you can talk to one of our advisors simply by reaching out support@mhq.co.nz and our team will put you in touch to talk to somebody and go over your cash flow strategy. Until next time, I'll see you in the next video.